All right. Hey, everyone. Thanks for tuning in. We're just going to go take a look at the markets here. Now, let's remember markets, one of the biggest things about trading in markets is understanding where the important price levels are. And we're going to go through some of them. And then I'm going to show you some charts for, well, a chart from back when the USS Maine was around, or the Maine. It says, remember the Maine. That was I don't know why they didn't say USS. But regardless, this was a battleship that got sunk back in 1898 and was one of the beginnings of the Spanish American War, and I'll show you. We can look at charts from the S&P from back then, believe it or not, and they look very similar to today. And the reason why is, well, people have changed, the companies have changed, the technology has changed, but you know what hasn't changed? Human nature. And when we look at charts, what we're looking at is human nature, human psychology. So if you don't understand that, you're never going to get it. All right, this isn't a chess match; it's more like a poker game. All right, so different things are more important at different times, and another part of being a good trader is understanding what to focus on. There's 11 sectors in the S&P 500, and different ones are in the driver's seat at different times. Right now, I think the important things to watch are the financial sector and the healthcare sector, and I will tell you why when we get to them. This is something that you can print out, I guess, or take a shot of it. This is the percentage of the S&P 500 that these companies are. I mean, sorry, these sectors are. And I have over here a little bit of review. Important things to watch though, the financials. Their financials are above support, but some of the industries are looking pretty vulnerable. And healthcare, kind of the same thing. S&P top of its range. If it moves higher, there's a good chance there's going to be resistance around the 480 level. Why? Well, it was the all-time high back in early 22. Okay, sorry, dating myself here. Um, And a lot of times when markets get to a price where they peaked out at before, there tends to be resistance again. And that's because the people that bought at the peak have it go right down after they buy it, and all of a sudden they're underwater. And a lot of them say, man, I made a mistake. If this ever gets back up to my price and I can get out at break even, I'm going to. So if it finally gets back up to their price, then you get these remorseful buyers coming out, and there's going to be a lot of sell orders, and that could put a top on the price going higher again. Prices go higher because there's not enough supply. So the buyers or the demand side have to be willing to pay higher premiums, and that pushes the price up. When we get to a resistance level, there's enough supply to fill the demand, and it stops moving higher. And then sometimes some of the people that are trading start to look around and say, hey, this isn't moving higher anymore. That must mean that there are other sellers coming to the market, and they start to get worried they're going to miss out because the buyers are going to go to whoever is willing to sell at the lowest price. The sellers start undercutting each other, and that causes a snowball effect. And this is why we sell off of resistance. This is what we're looking for. Things that get to support or resistance because of many times, not always, but many times, they tend to reverse. And that's where we make our money. Here's the bonds, right? The bond ETF. Very important to watch here because it got up to a resistance level and it's selling off. Like I just said, sellers are undercutting each other. Why would you get resistance at a support level? Buyer's remorse manifesting itself in a different way. There's people who bought here, get underwater, and like, all right, it's back to my price. I can get out of break even. I'm going to. So support can turn into resistance because of buyer's remorse. Important chart to watch here. The whole street is pretty much focused on interest rates. And remember, bonds are inverse to interest rates. So if the bond trends lower, and for the time being it is, that's going to make rates go higher, and that's bearish for most of the stock market. Not all, but most of it. Here's our tech sector. Okay, there's a good chance that we see some reversal here. Remember, this is our biggest sector. Because we're getting to a level that was resistance. So there are people who bought here. I guess that's probably mid or late December, and then the price falls apart and gets back up, approaching a resistance level. You tend to have resistance at former resistance levels. Check this out. This is a good example here too. You tend to have support at former support levels. This is because of seller's remorse. People sold here and the price goes higher. They regret it. They're like, oh, I'll buy my shares back. So you tend to get support at levels that have been support before because of seller's remorse. You tend to get resistance at levels that were resistance before because of buyer's remorse. Why is this important? Because when securities or markets get to these levels, they tend to reverse. Not always, but if they're reversing, if a market's reversing, that's where our trading opportunities are. All right, so here's healthcare. This is a good example of market memory. Check this out. We stalled out at resistance at the same level that was resistance way back in 2021. We get to resistance. Remember, remorseful buyers try to sell, they undercut each other. Get to resistance, you sell off. Overbought, that's going to draw sellers into the market. Good chance there's going to be some trades on the short side in the healthcare sector. Here's the biotech ETF, which is the biotech industry is about 16% of healthcare. And look at this. It looks like it could be reversing at an important level. The healthcare equipment industry is 20% of it as well. And look at that. Support. Remember we talked about support can become resistance because of buyer's remorse. So if these two industries start to reverse and they look like they're each where they can, maybe imminently, that's going to bring down healthcare. That's going to bring down part of the broader market. The same thing here, right? The biggest part of the healthcare sector is the pharmaceutical industry. And this is at a position where, see, resistance became support, become resistance. One of the main things about trading to understand is that some price levels just happen to be more important than others. And sometimes we know, sometimes we don't know why. Doesn't matter. If you know where they are, it can help you profit, right? You bought down here. Just say you bought down here and you say, oh, okay, well, if it gets to 45, I'm going to sell. You're just guessing. Maybe it gets there, but the odds are better that it probably gets here and starts to reverse. So you would have missed out because you just guessed. You didn't let the market tell you what to do. If you looked at the chart, you would have said, oh, there was resistance and support at this important level before. That's probably where it's going to turn, so I'm going to put my sell order there. The market tells you what to do. The market tells you where to place your buy and sell orders. At least it should. So here's the financials, okay? Trading about this important 37 level. If you see XLF start to go below $37, it's probably time to get on the short side of things, buy puts or buy inverse ETFs. I wouldn't suggest buying or shorting, especially if you're new. I've never shorted a stock in my life, at least personally. I mean, I have in my business world. But look at this. So here's the financial services industry, almost a third of the sector. Resistance became support. It's testing the support. If something trades below support, we say the support is broken. It's not just symbolic. It tells us that the traders who created the support with their buy orders have left the market. Maybe they're canceled. Maybe they finished their orders. But when you take supply out of a market, in other words, when the buyers get fulfilled and leave, if new sellers come in, they're going to have to push the price down to get their orders filled, and that causes the downtrend. And if we start to see this give way, here's the bank ETF. This is the banking industry, a quarter of the sector. The descending triangle pattern tends to be pretty reliable because it shows us that there's buyers that are just chilling, hanging out. It also shows us that as time is going by, there are sellers who are willing to take lower prices. This is why these peaks are forming at a lower price than the prior peak. Markets go in peaks and valleys, and when the peak is at a lower level than the prior peak, it tells us that the sellers are getting more aggressive. So you got aggressive sellers, complacent buyers, sets the stage for a move lower. Here's the capital markets industry. A little bit of a reversal pattern here, testing support here. So if these industries start to give way, There's our insurance testing resistance, and like we saw, things could reverse off of resistance. If these industries all kind of start to reverse, obviously the sector is going to reverse, and if the financials break that important support we looked at, that's going to be, I think, a catalyst for a big move lower. Healthcare as well. So you could get these two sectors, financials and healthcare, the second and third biggest sector in the market, reversing, and maybe the others follow. But right now, I think those are the two most important things to look at. Consumer discretionary, trading at an important level here. Obviously, this is important too, but I don't think as important as those. Communication services actually looks pretty good. A little trend higher. Industrials going sideways. See, if something's going sideways and it's neutral, the momentum is neutral, I don't think it's really going to do much. Something's really overbought and at a resistance level like healthcare, there's a chance it makes a meaningful move. Metals and mining. So just see how resistance became support. This is another part of the industrial sector. See, look at this. Got to resistance back here. Same precise level here. Market memory. This was June of 21, and this was basically 2 weeks ago. Market memory refers to the fact that certain price levels that are important can retain their importance for a long time. Consumer staples also at resistance. Remember, when things are at resistance, there's a good chance they reverse and start to go lower. Generally, it's not a good idea to buy a stock if it's at resistance. In general, I mean, you never know. This is the market, but you got to just kind of play the odds. You're going to be wrong. The best traders are wrong, but if your mistakes are small, then your winners will work themselves out and you will do very successful. Energy sector, check this out. Remember seller's remorse? We find support at a level that was support, and now the opposite of what we talked before. Now the buyers start to think, gee, there's other buyers coming into the market, and I better step up because the sellers are going to go to whoever's willing to pay the highest price, and the buyers start to outbid each other, and that causes an uptrend. Crude oil, okay, we can see here what was resistance became support, what was support became resistance. For whatever reason, oil likes the 74 level. So if you're an oil trader, you can kind of just trade around this level. And utilities shows resistance, becomes support, seller's remorse, people sell. Price goes higher, like, I made a mistake. If it gets back to my level, I'm going to buy my shares back. So the moral to the story is pay attention when things get to former levels that were important. How do you know it's a former level that was important? Well, something that was a peak or a valley before, or a support or a resistance level before, market memory. These important levels tend to stay intact for a while. I know some of you are trading on this reversal in the material sector. See, got to resistance and sold off. Got to support and rallied. You can see these things, these same patterns and charts of different things, because what the patterns are is an illustration of human psychology, and humans have the same psychology regardless of what they're trading. ETFs, cryptos, stocks, bonds, and so forth. All right, anyway, here's the USS Maine. I'm a big history buff. I just thought this was kind of cool. I mean, it's not kind of cool that the ship got sunk. They thought it was sabotage back then, but now we know it was an oil burner that blew up. But here's what I want to show you. This is the S&P from 1871 to 1933. This is where the Maine exploded. But pay attention. Look at this. What was resistance became support. What was support stayed intact. What was resistance stayed intact. Support here became support here. No one who's listening to me right now was trading back then unless you're like a time traveler. But the reason why we could see these same patterns is because back then maybe the people were different, or I mean they were different names or different people, and technology might have been different. But what isn't different is human psychology, and that's what a chart is. So pretty amazing. This if this wasn't up here and this wasn't down here, this could be a chart from like last year. All right, everybody. Thank you for tuning in, and I will see you soon.